Hi everyone, we're here today to talk about why insurers are moving to a global operating model. So let's start with some quick introductions. Vikas, do you want to go first?
Yes, thank you, Dennis. Hi, everyone. My name is Vikas Bhalla. I run the insurance business for EXL. I have also the responsibility of managing EXL's international markets and delivery geographies.
And I'm Dennis Winkler. I run the insurance practice at ISG. ISG is the global leader in sourcing advisory with over $500 billion of digital technology and business process sourcing transaction, including global operating models. We wanted to get together today because we've seen a tremendous growth in how insurers are using their global operating models, building new ones, and changing how they leverage them. And this is due to several factors: increasing cost pressures from inflation, continued shortage of talent, and the growing adoption of hybrid working environments. The insurers that are succeeding today are ones who have adopted this model, who are digitalizing, diversifying, and leveraging the global operating model to its fullest capabilities. These global operating models have existed for years, and insurance carriers were some of the first people to build them and adopt them. And they achieved, the labor arbitrage and cost savings from these. We've seen service providers grow significantly in this area as their insurance capabilities have grown. Their technology and automation excellence has come to add value, and the ability to recruit and retain at scale has impacted their ability to increase the value of carriers' hybrid operating models. So initially, all of the carriers that initially set up their offshore centers were setting up in India. Maybe some voice was done out of the Philippines, but we've seen that change significantly, again, usually with carriers who are leveraging third parties. And we now see centers in Ireland, in Eastern Europe, in South America, in South Africa, and all over the globe. So Vikas, why do you think insurers are moving to diversify and expand operations in new geographies?
So, Dennis, as you said it, global delivery brings a significant set of advantages, and we have seen insurers over the last 25 years progressively use global delivery models. And what we have also seen is that in the last 4 to 5 years, and particularly during and after COVID, that move to global delivery actually has accelerated. In my mind, there are four key reasons as to why insurers look for global delivery. I think first is just the access to a diverse talent pool. So we have seen over the years that access to talent actually is becoming more and more difficult, particularly in the developed markets. And even if it is available, it is coming at an increasingly higher cost. And global delivery allows you to access talent in the right location, as we say, the right scale in the right location at the right cost. And while global delivery brings a comprehensive set of talent availability, but when you look at specific niche areas, like, for example, data analytics, digital, some of the more complex operations like finance and accounting or actuarial, you'll find that availability of such talent is becoming more and more difficult, and global delivery allows you to tap the talent pools in different geographies to be able to have access to that. So the first reason is access to talent. The second reason is to have resilient operations. While this has always been a requirement for insurers, because for them, both from a revenue generation perspective as well as from a customer service perspective, continuity of operations, short term and long term, is extremely critical. And what we have seen is that particularly during the COVID event, insurers who had not used global delivery realized that global delivery models are more resilient, because once you actually have split your operations across multiple geographies in multiple countries, there is this inbuilt resilience which comes in. And so we're finding this accelerated move towards global delivery purely driven by the need for operational resilience. I guess the third area is cost effectiveness. No one delivery geography can provide you with the most optimum cost from a skill perspective. But if you put a global delivery model in mind, you will be able to optimize the right skill at the right cost. So a comprehensive solution will require an integrated global delivery model with different countries, different regions, different cities providing different skills so that the overall cost can be optimized. And finally, I think access to technology and disruptive new trends. Now, interestingly, what we've seen is that global delivery brings in global best practices. It brings in talent which is available in niche areas like digital transformation, data, AI. So, insurers who actually have their operating models in sort of more global, diverse locations have better access to such talent and are able to access transformation. So, what started out as purely a cost or labor arbitrage now has got multiple advantages, and that's why we've seen the acceleration towards global delivery. And that brings me to a question for you, Dennis, that how do you see insurers embark on this journey of global delivery? And what are some of the key drivers that you have seen as, progressively as we've seen more and more insurers moving towards global delivery and global operating models?
Yep. I think I think of it in two ways. So one is sort of the history of what insurers have done with their global operating models. And then the second is if you look at it, the life cycle of an individual captive center, uh, I think there's two interesting stories. So, let's talk about each. So the insurance carriers were some of the first people to build them, as we said. Back in the 90s, people like AIG and others to address Y2K set up shop in India back in the 90s with app dev and some basic low-level transaction processing and got significant cost savings. We then saw in the 2000s, everybody try and duplicate those models. Everyone was setting up in India. Everyone was moving their back office processing there. We then in the two, then we started to see those start to stagnate. So, the centers were not, got through those first couple of years of cost savings, but couldn't deliver additional cost savings and couldn't transform to the level that the people were looking for. And when the financial crisis hit in 2008, we saw a big wave of people monetizing those captive centers, and we were involved in a lot of those deals
Yeah.
where people then look to providers to purchase the captive center and enter into an outsourcing transaction where a new hybrid global operating model was created. Then, as you said, with COVID-19 hitting, it all started over again with talent shortages and cost
Yeah.
pressures. And there was renewed interest of people looking at how do we take advantage of a global operating model. So there was both new centers being created, often leveraging a third party, or reconfiguring the existing center, and again, leveraging third parties to bring in automation, to bring in new recruiting, not the low-level transaction people, but you said the higher, more complex processes, and then to look at new locations, as you mentioned. So I think that history has resulted in where we are today with these global centers being viewed not as low cost back offices, but as true
Right.
business partners with centers of excellence driving new technologies. So that's sort of the history of what's happened. But if you look at any individual center that we see insurance carriers set up, it's a similar life cycle. Everybody's trying to get that labor arbitrage and address the talent up front, and most achieve that. In a couple of years, you work through your transition, you're getting big cost savings, you've got your team in place, everyone's happy. Year 3 and 4, it sort of shifts to say, okay, how do you get us more cost savings, or how do you improve operations, or how do you drive more value to the business? And by year 5 and 6, we see most carriers hit an inflection point that says we either have to really invest to get this right, or we should look at moving it. So, again, that is where we tend to see providers step in and help in those situations. So
Yeah.
I think the carriers that have learned from this history and are starting that journey again are looking to providers from day one and saying, how do we do a build, operate, transfer model? And you could help us build it and operate it. And then truthfully, what we see is rarely do we see it ever transferred. So,
Yeah.
how do you see the role of service providers evolving as they work with carriers and global operating models?
Yeah, so just picking on a few points that you made, Dennis. So, when the whole offshoring started, now I tend to not use the term offshoring because I think it's much more about global delivery and not offshoring, because offshoring is restrictive in many ways. But when the offshoring trend started, and insurers initially wanted to set up their captives, if you look at the economic value curve, there was a sudden benefit that insurers got. And then as years progressed, that economic value curve wasn't improving because cost was going up in a captive, and incremental value was not coming. So service providers like EXL and others look at that same economic value curve. And so the challenge is, on an ongoing basis, how do you keep improving the value curve for insurers so that insurers prefer to work with partners and service providers rather than actually set up their own shared services or captives? And let's see it from a client perspective. So if a client is actually looking at working with a service provider, so the first question in their mind is risk being managed? Because there's always this, at least in the past, there was risk associated with a service provider bringing in global delivery in a offshoring kind of a mindset. And what I can tell you is that over the last many years now, progressively, service providers have become much better in managing risk. So that comes in through improved compliance, comes in through better governance, comes in through investments in information security, cybersecurity, and everything, regulatory compliance. So what service providers have done is invested in the area of risk management and governance, so that the fear of risk actually has significantly gone away. So that's the first evolution, which is how to manage risk better. So at least that concern is not there anymore. So that's number one. I think the second area is progressively improved global delivery, because, like I said, it's not about offshoring to India or to Philippines, it's about global delivery. And EXL, as well as many of the other service providers, have progressively improved on global delivery. So you're right, it started in many ways with captives or shared services or outsourcing operations starting in India, and then Philippines became big, particularly in customer interaction. But then progressively, we've seen South Africa, we've seen Central and Eastern Europe, we've seen Colombia, we've seen some other nearshore centers, and to complete the global delivery picture, we've also seen the onshore centers, because to be able to do end-to-end work, you need some onshore work as well as some offshore work. So service providers have significantly improved and enhanced their global delivery models by adding more and more locations, and still providing a single point accountability from a client perspective. And the third area then is value addition. Now in value addition, there are three things which come to my mind. The first is around domain. Now, 25 years ago, when this industry was still fresh, you would not be expecting deep domain expertise, because you were expected to learn it as you got into client engagement. But as service providers have become more and more mature and sophisticated in the domains that they play in, they have improved on the domain capability. So as you know, that EXL actually focuses a lot on insurance, with close to 50% of our revenue coming from insurance. So what we've done over the years is significantly improve on domain, whether it is in terms of providing education to our people, in terms of insurance certifications, whether it's in terms of training academies, whether it's in terms of technology platforms, data and analytics practices dedicated on insurance. All of that actually brings out value when you actually have domain. The second is around data. So to be able to create value, you need to be able to use data in a way so that it can actually bring intelligence to the operations and make it better. Most service providers have practices around data and analytics, and a significant part of EXL's revenue actually comes from data analytics. So that's the second area that most service providers, including EXL, have matured on that. And the last one actually is around technology. Now, service providers in our kind of an industry, which are not IT services, don't have very large technology capabilities, but they do have technology capabilities in niche areas where we know that our clients are underinvested or where in specific areas like digital transformation. So improving the way we manage risk, bringing in a more and more comprehensive global delivery, and then adding more value through improvements in our domain capabilities, our specific technology capabilities, and in data and AI. I think those are some of the evolution steps that most of the service providers have taken in the last few years to make sure that that economic value curve, which sometimes in a captive environment can become quite static, with a service provider it can just keep going up. And that's what most service providers and EXL in particular has done over the last few years.
Yep, I agree that I think the tremendous growth we've seen in carriers leveraging third parties really is that domain expertise and insurance operations specific technology enhancements and process enhancements capabilities. So, Vikas, can you tell us a bit more about EXL's specific journey in insurance operations?
Yeah, sure. So, we actually started out servicing insurance companies. So, in fact, we're one of the very few, if possibly the only one, where we actually started out as providing services to the insurance industry. In fact, we were, for a very brief period, at the very early stages of our history, for a very brief period, we were actually a captive of an insurance company, but that lasted only for a few months before we became a third-party service provider again. But we've sort of cut our teeth on insurance to begin with. So we actually had a bit of an advantage. But let's start with global delivery. So since the conversation topic is around global delivery, to be able to provide services to insurers, we have kept enhancing our global delivery engine. So we have extensive operations in India where we do a lot of complex F&A work, complex claims processing, complex policy admin work, data analytics, digital transformation, actuarial work. We have significant operations in Philippines where we do the corresponding customer interaction work, a lot of clinical work, including nursing talent and clinical and US registered nursing work. We have operations in South Africa where we actually provide these services, initially meant more for the UK market, but progressively we are doing a lot of work for the US market as well as for the Australian market. So that is sort of a resilience operation along with the resilient operation along with Philippines with respect to customer contact. Then we added Eastern Europe and Central Europe to provide European language support. We have operations in Colombia, and then we have significant operations in onshore. So that's been one dimension of evolution. As we have significantly, progressively improved our global delivery, we can bring more end-to-end capabilities and services to insurers. So that's number one. I think the second one is we have progressively built capability and moved on to higher levels of services. So I look at EXL's evolution in the last 25 years, and I've been there with EXL for 24 out of those 25 years, in three sort of decades. The first decade was around operations. This is where significant amount of focus and investment was going in terms of becoming better and better in insurance operations. The next decade was around data and analytics, and this included some inorganic investments, but many of these progressive organic investments and focusing on data analytics and focusing only on insurance data analytics to make sure that we are targeted on insurance industry. And then the third generation is around digital transformation, but here our value proposition is not heavy technology led, but heavy data led and technology enabled. So more focus around creating digital transformation using data. So as we move from operations to add data analytics and digital transformation, we have progressively moved up the value curve. And the true value that we can create for insurers is by integrating these capabilities. So if you're running a claims operation for an insurer, we can not only run the operations using global delivery model, but we can also provide the associated data analytics in terms of customer, in terms of fraud, in terms of catastrophe modeling, in terms of reserving, and then also provide that intelligence using digital. So that has been a continuous investment and evolution for us on an ongoing basis. The third area where we have focused is to progressively keep becoming a more and more complete provider with respect to product lines and and services and functional areas. Um, we try and cover, and we're trying to complete that matrix, and we have been able to do it in many ways, is to make sure that for both life and annuity and retirement services, as well as for property and casualty, whether it is personal lines, commercial lines, multiple product lines, the GL business, we are a complete provider of services. Now, an interesting example is cyber insurance. Now, that is still an underserved part of the market because it is still in the early stages and growing. So we are actually working on including that in terms of our product portfolio as to what kind of services cyber insurance needs. So that's an example of the kind of thinking we bring in terms of making this matrix more and more complete. This completeness of service and product capabilities puts us in a nice spot with respect to providing services for insurers. And then finally, it's about adding value, and adding value not only through data analytics and AI, but adding value even through some specific technology platforms. Now, given our focus on insurance, like I said, close to 50% of our revenues coming from insurance, we've invested in technology platforms in three or four different categories. So, policy admin engines. So, we have one of the largest installed bases of policy admin for the life and annuity business in the US. Niche technology, which is new generation technology. We have one of the best new business engines for insurance, which is a low code, no code, fully digital customer journey, data and analytics based engine that we're actually using to help insurers bring in new business or launch new products, or in specific areas which are big industry level problems which are underinvested. For example, the subrogation business, we bring our own technology platform. So we made sure that we're not just bringing in a pure human intensive service capability, but we're bringing in technology platforms that we need. Now, clearly, all of this did not happen in the first 2 or 3 years. So it has taken us a journey of 25 years to progressively keep building on these components. And our objective is to be a strategic partner to the insurer, which means that as the insurance company is looking at becoming more modern, becoming more data-led, become more AI-led, run their operations in a futuristic operating model, we can position ourselves as a partner. It's taken us a lot of investment over the last 25 years with a very deliberate focus on insurance. So that's been, how we have focused on. And Dennis, just coming back to that whole area of global delivery. One of the questions which I think many of the insurers have, particularly the ones who have not yet used the global delivery model, is this whole captive or shared services versus outsourcing debate. And I clearly have a point of view, but I can be seen as partially biased because I'm a service provider. But it'll be good to get your views on how do you see these two models, and how do you see those pros and cons, and how are insurers thinking about it?
Yeah, yeah. My point of view is I thought that the market had decided this a decade ago. That,
Okay.
when we did many of those large captive monetization deals and helped insurance companies move their centers to providers and help create these global operating models. So we saw the big carriers figure out that it was better, faster, cheaper to partner with somebody to create a new solution and co-create what they want their future to look like versus trying to build it all themselves. The investment it takes to do that is just beyond where most insurance companies are. I mean, just look at generative AI, which you mentioned. So providers are publicizing the billions, literally billions of dollars that they're investing in this new technology. No individual carrier's going in at that level.
Mm-hmm.
They're not, they can't get it supported by their board. There's not the ROI, because they're not spreading it the way that a provider could. And so I think that even now, like we said earlier, when we see people start that captive, what we're calling captive, a new global center approach again, they're starting day one with the provider saying, "Hey, here's how we want to do it. We want to do these bits. We need help doing this bits. Can we leverage whatever it is they're looking for? Your recruiting capabilities, your technology, but I think people aren't no longer looking to buy, can you process my claims? Can you give me some FTEs? It's really,
Yeah.
here's what my problem is. I need a partner to help me figure out the solution, not just today, but in an ongoing way that, we don't have, as you said, that sort of stagnation that we see people experience when they try and do it all by themselves. So, I think my view of the future of where it's going is that optimal mix of internal and external and local and regional and onshore and offshore. It's just going to remain an ongoing evolution and require ongoing evaluation to meet whatever the carrier needs are of the day. So, as we've seen more of those low-level transaction processes get automated, we're seeing the big bang from global capability centers be the higher level things that you talked about, getting an actuarial team offshore or an actuarial support team
Mhm.
offshore. It's just a huge cost saver compared to what they would be in the US. And then two, finding the people with those capabilities is, often much easier offshore than onshore. So I think those types of value evolutions will just continue to happen. And what people are doing through their third party providers and through their global operating models in 5 years and all look different from what it looks like today. But I think those who partner in doing it are going to have greater success than folks who try and do it all internally. Let me ask you the same question, flipping it around. Where do you see global operating model playing out?
Yeah, so frankly, we have seen our experience is quite similar to your experience. So I think when the when the problem statement was how can I offshore for labor arbitrage, the answer could have been a captive versus a service provider. But as the nature of the problem statement has changed to how can I use global delivery and and accelerate my transformation, insurers are realizing that the captive solution is not optimal, because if an insurer is looking at setting up purely just an offshore center, it's going to be an offshore center and possibly another one. But what a mature service provider will bring to the table is a complete global delivery, so that you can actually have that global delivery model servicing your operation in the right way. And the second one is regarding transformation. So what a captive gets no benefit of is best practices, technologies, and investments that require scale, which a service provider can do in specific functional areas. I gave you this example of subrogation. Now, subrogation is one of the areas where it doesn't make sense for an insurer, even a large insurers, to invest a lot of money in maturing their subrogation capabilities, be it in terms of technology platforms or AI and so on and so forth. But when you actually start doing subrogation for multiple insurers, then there is a potential of actually investing in that and making the technology better, making the data flows better, using better digital and AI in that, and frankly, the potential of actually slowly becoming an exchange as more and more volumes go through you. So transformation limitations are certainly there in captives because you are still limited there. So in my mind, as we have changed this conversation from how do I offshore to get labor arbitrage, from there we've moved to how do I use global delivery and accelerate transformation. We are now realizing that insurers are realizing that a mature service provider who has got insurance domain knowledge, has got data capabilities, can accelerate our AI transformation journeys, can bring in niche technology in underinvested areas because it makes sense for them to make those investments rather than us. All of those are actually now gravitating more and more. And there are insurers who have captives, and many of them. But I can tell you the conversations we're having, many of those insurers is how do we basically improve the outcome of those captives? Now, it could, and the two kinds of conversations. One is, can you come in and see what you can do to optimize the captive? Which is, now that you have these best practices from all the other engagements you have, can you actually come and deploy that in sort of a consulting mode? But then the second more powerful argument is how do you augment it, which means that I'm limited by what I can do in my captive, but now that you actually have a much broader global and faster transformation capability, how do you basically now do it in a much more comprehensive way, which potentially could be a carve out or just an augmentation, and have a third party. So you find those conversations are much more evolved today than what they were about 7 or 8 years ago, when the problem statement was a little bit different. So yes, significant amount of change and evolution in that thought process from the insurer perspective.
Great. Well, thank you. I think it's been an interesting conversation, so I appreciate it. Any final comments from you?
No, Dennis, thanks for taking the time. I think this is a very useful conversation, and I'm sure you are going through such conversations with insurers, and trust me, we are going through these conversations with many insurers. If anything, what has happened, I think, due to COVID-19 is insurers are realizing that their operating models need to change. They need to transform much faster. The transformations have to be cost effective, have to be nimble, and they need resilience in their operations. And so I think it is a tremendous time for creating really strategic partners between service providers like EXL and insurers, and just exciting times ahead.
Great. Thank you.
Thank you, Dennis.